All right, I'm going to do a little bit of a talk through, a lecture, if you will, discussing not-for-profit organizations. So you want to turn to section 4 in your Accounting 310 workbook, and you can follow along with me if you feel like it. If you find all of this stuff boring, you can go ahead and attempt some of the problems, which I will do in another video. So I'll talk just in general about some of the theory here now. We talk about not-for-profit organizations. There are actually no international standards governing the accounting for not-for-profit organizations. So this IFRS doesn't refer specifically to not-for-profit organizations. So standards can differ from country to country. They need to be tailored specifically to whatever country's not-for-profit organization environment you've got and various regulations surrounding not-for-profits and how they operate. So no standardization. So if, in fact, a Canadian not-for-profit organization must follow GAAP, and we'll see later that in many instances there are no requirements to follow GAAP, then what it would follow would be what we call Part 3 of the CPA handbook. So again, not all not-for-profit organizations need to even follow GAAP. So there are some frequently requirements for funding or specific legislation that requires a certain not-for-profit organization to follow GAAP. If that were the case, then they would follow what we call Part 3 of the CPA handbook. So Part 1 of the CPA handbook, if you were unaware, is International Financial Reporting Standards. Part 2 is Accounting Standards for Private Enterprises, or ASPE, IFRS or ASPE. And then Part 3, at long last, is the guidelines for accounting for not-for-profit organizations. Now, these organizations could voluntarily choose to follow GAAP, but oftentimes they're under no requirement to do so. Let's talk a little bit about some of the differences between for-profit enterprises, accounting for for-profit enterprises, and accounting for not-for-profit enterprises. So one of the key issues here is the ownership. So with a for-profit corporation, it's easy to transfer ownership. If I own shares in some corporation and I want to divest myself of those shares or transfer the ownership to somebody else, I merely need to find somebody who wants to pay for those shares. There is no transferable ownership with a not-for-profit organization. Effectively, nobody owns it. So it's not easy to transfer from owner to owner, given that there are, in fact, no owners. So given that there are no owners, there's no owner's equity section in a not-for-profit, which can be a little confusing. Right? You're still going to have a balance sheet per se, and we'll take a look at the different financial statements. But what you're not going to have is a shareholder's equity section. They will have what we call a net assets section, which is assets and liabilities, which, look, assets minus liabilities would generally equal your shareholder's equity section of a balance sheet. But you can't call it owner's equity, right? Because it ain't. There's no owners. So usually, again, we'll call this side of the balance sheet or this component of the balance sheet net assets, or sometimes we'll call it fund balances. So take a look at the distinction here. In a for-profit company, we've got assets minus liabilities equals shareholders' equity. Sure, you've seen that a million times before. No problem. In a not-for-profit organization, you have assets minus liabilities equaling net assets. What? I know, it's just a chunk of your balance sheet and it's called net assets instead of shareholders' equity. You may also see it listed as fund balances, and I think in one of the examples that we're going to take a look at, it's referred to as fund balances. We'll talk about what funds mean shortly. So no one owns an NPO, and NPO. You can't transfer ownership like shares. You can't withdraw. No one specifically can withdraw any funds for any personal use purposes, right? There's no ownership, so there's no dividends that get paid out of shareholders' equity. You can't buy and sell shares, right? Buy shares for a low price, sell them for a high price of a not-for-profit organization. So the shareholders' equity section tends to look pretty generic. And we'll take a look at what those look like. Now, I'm going to talk a little bit about objectives, and when we get into the objectives of the organization, this helps us sort of understand and realize how the accounting is going to be done. Now, for a profit-oriented enterprise, what's the purpose of that organization, right? This is the vast majority, 99% of the organizations you would have seen thus far in your brief but fruitful, I'm sure, accounting careers. The purpose of the organization is to maximize profits, right? So therefore, it's driven by revenue, right? Revenue driven. The effect on accounting that you guys would have heard alluded to in the past is something that we call the matching principle, wherein any expenses that are incurred are matched to the corresponding revenue that is earned. For example, amortization is recorded over a period of time because the purchase of a capital asset has a lifespan that is generally thought to be longer than a year for most capital assets. And throughout the lifespan of that capital asset, revenue is generated by virtue of the fact that that for-profit enterprise has access to the capital asset. It doesn't churn out money specifically, but by virtue of the fact that the corporation can use it, they are generating revenue. Correspondingly, the amortization of that asset occurs over time. The expense is, we attempt to match the expense with the revenue that is produced over time. This works for prepaids and FIT as well. I'll let you use your imagination as to how that works with the matching principle, but there are a number of examples in previous accounting courses. So not-for-profit oriented enterprise, they don't exist to make profits, right? They exist for social, educational, professional, religious, health, charitable purposes outside of strictly making money. Now, they are in the business of generating revenues, but that revenue tends to go towards, instead of increasing or maximizing shareholder wealth, which is the purpose of a for-profit enterprise, rightly or wrongly, a not-for-profit organization earns revenues in order to, in many cases, attempt to better society through social causes, education, sort of professional organizations, like if you're a member of the CPAs of British Columbia, it's a not-for-profit organization, religious organizations like churches, etc., health, like hospitals. And then you guys would be most familiar with charitable. Wow, I'm on the wrong setting for that pen. It's supposed to say hospital. Charitable organizations, etc. Right, and most of you can probably can think of a number of examples of charitable organizations that you would have donated to, or worked for, or been involved with in some capacity. So these enterprises are more service driven. They're driven by expenses. They're providing a service, and the expenses that are incurred is generally going to drive the accounting. So the matching principle is effectively reversed for a not-for-profit organization. Revenue, instead of matching expenses to revenue in for-profit, the attempt here is to match revenue to the expense. So frequently, a not-for-profit organization, and let's pick a charity because it's the easiest to sort of manifest in our brain, they'll receive funding now for some kind of an event that's going to take place next year or in future years. So the funding or revenue tends to be deferred until the actual expenses are incurred. So in addition to this, it's worth noting that disclosure in the financial statements of the organization is required regarding the purpose of the organization. This is if, of course, the not-for-profit organization is following Part 3. And most of what we're going to refer to in here for not-for-profit accounting is assuming that the not-for-profit organization, or NPO, is going to adopt the guidelines laid out in Part 3 of our CPA handbook. Okay, so talk a little bit about the objectives of the financial statements. So we talked about the objectives of the organization. What about the objectives of the financial statements, and who are the users of financial statements of not-for-profit organizations? For profit-oriented, you guys will have seen enough of these things now. Who is using the financial statements? Who are the quote-unquote users of the financial statements? Well, generally we've got investors, people looking to invest, or current investors, and they're looking in the long term at maximizing their profitability or their return on investment, etc. So they're using the financial statements to take a look at in the short run, and to simplify things, let's say profits, all right, cash flows as well. Now the owners potentially may be using financial statements in order to minimize tax. Anyone who's taken a tax course would understand that. Cash flows is a very important indicator. They could be used by investors or creditors. Creditors would include entities like a bank, etc. And management is also a key user of profit-oriented financial statements because they're looking to make projections for the future. They're looking to also take a look at the past performance and gauge where they can make changes. Now, for something like revenue recognition in a for-profit enterprise, there can be alternatives, as we would have seen in previous accounting courses. So the alternatives and the choice for revenue recognition could potentially take into account the objectives of what the users are. So there could potentially be alternatives for the recognition of revenue. For example, you've got, let's say, long-term contracts for, big capital projects, and the revenue could be recognized under ASPE using a percentage of completion or completed contract method, depending on what the user requirements are. Now, not-for-profit is what we want to think about here. Who uses those financial statements, and what specific financial statements are of use? Well, you're looking a lot more at things like cash flow projections. So those people in charge of management of the not-for-profit organization are taking a look. They're always taking a look. And now I've served on the board of a not-for-profit organization, and the number one concern in any not-for-profit organization is cash. And do they have enough cash to get through the next week, the next month, the next year? And so they're taking a look at those projections, seeing, well, where are their main costs going to be incurred, and how can they manage that? So yeah, the users are looking at cash flow projections, and they're taking a look at those statements to, basically gauge how much cash they're going to have in the future. Contributors. So contributors and donors are kind of different things. The distinction is not that important for the purposes of this course, but contributors may be thought to make larger contributions like buildings or endowment funds, etc. And donors tend to donate. You guys have probably donated to charity before, where you're doing some kind of a fun run, or somebody comes around canvassing and you give them $20, or you're donating at work for some specific organization. And the contributors and donors are looking to see how that cash is spent. They're looking at the stewardship of the organization. How is the organization run? Are the contributions that I'm making going towards the actual programs, right? What the money was intended for a specific purpose. Is it being spent on that purpose? So cash flow is very, very, very critical, and there's a huge focus on budgeting. And I would highly recommend to all of you at some point in your accounting career, if you have time and you have inclination, to volunteer for the board of one of these not-for-profit organizations. It can be very rewarding, and it's also very interesting. And certainly there is a strong need. There are always boards in need of personnel with, any kind of accounting background whatsoever. And that can be hard to come by, because frequently accounting people want to look to be compensated. But this is a chance to sort of give back and actually get involved in organizations that you might be interested in. So the focus is in most not-for-profits to take a look at cash, because it can be very, very difficult to raise money. Okay, I've blabbed on for a bit here. Let's move along. Now, as alluded to, given the focus by donors on the stewardship or the management or running of the organization, they definitely want to be able to see that their donations have been spent appropriately, and they want to compare it to other not-for-profit organizations to see, well, how much of the money that gets donated is spent on administrative expenses. And that can be quite high in various not-for-profit organizations. Sometimes in excess of 90% of the donations that you may make to a charitable organization would go towards the administrative fees. So potentially this could result in some kind of a bias by the not-for-profit organization to reclassify administrative expenses. So part 3, again, that's part 3 of the CPA handbook, has specific guidance on expense disclosure requirements, and you can read about these here in the specific GAAP pronouncements. I think that for the purposes of moving this along, me reading through the GAAP is not that value added for you, but you always have this reference to go through if you'd like to. Now let's think about the sources of money. Where, if you're a profit-oriented enterprise, do you get money from, and what's the difference for a not-for-profit? Well, profit-oriented enterprises receive money via selling goods or services, right? So when the revenue is received via the sale of goods or services, right, the provision of those goods, or the provision of those services, and the transfer of those goods helps us determine when revenue is to be recognized. And generally, one of the items we look at is substantial performance. Is performance complete of the service? Is provision of that good complete? Did we actually deliver the good, and did somebody else take possession of it? Now, in a not-for-profit organization, it's a different story, right? You're not generally selling stuff. Now, that's not to say not-for-profit organizations can't sell things, Girl Guides, but the majority of the quote-unquote revenue or money comes from contributions and donations. So generally, when you are looking to donate or contribute to a not-for-profit organization, there is no reciprocal arrangement. There is no financial return, right? If you go to a profit-oriented enterprise and you buy something from them, here's the exchange. You give them money and they give you a thing that you want, or they provide a service that you want. For a not-for-profit organization, that's not so much how it goes. You donate presumably out of the goodness of your heart in order to advance some sort of societal belief that you hold dear. So the revenue recognition in this case may not require any level of performance, meaning there is no good that has to be provided. There is no specific service that needs to be provided in order for the recognition of revenue to take place. And this, we call this non-reciprocal in nature, the non-reciprocal arrangement. So then we come down to the issue of, well, what are we going to do? When do we actually recognize contributions, right? What is the service or good that has to be provided, or what is the benchmark of when to recognize revenue? And we're going to get into that, right? We're going to get into that. Now, I've sort of talked through, I added in some notes here on my own, but I've kind of talked through all of this already. I referred to the revenue recognition and percentage of completion versus completed contract in ASPE. And then really the focus of various not-for-profit organizations, which is specifically for cash flow. Now, cash flow, again, just really quick, can be tough to manage if you're a not-for-profit organization. If you're a for-profit organization and we're short on cash, hey, what's McDonald's going to do? McDonald's? How about McDonald's? They're going to sell some, that's really great. They're going to sell some more, Big Macs or some French fries or some Shamrock Shakes, whatever it is they're doing. They're going to offer you some free coffee. McDonald's is looking like profits are down for the third quarter, so they'll say, come in, get your free delicious McDonald's coffee, and while you're there, you're probably going to buy 16 Egg McMuffins as well. Now, for example, an organization such as the United Way, you can appeal to donors, right? You can appeal to the government, but there's nothing that can necessarily drive that. Although you do see organizations, on TV that'll have like a pledge drive at a certain time of year in order to, and it'll be something that people are familiar with on an annual basis, wherein they can drive some revenues and some donations, but it's hard to do just off the cuff. This not-for-profit organization is short on cash. How do we drum up more money? And that can be difficult to do. I've already talked through all of this, so I'm not going to talk through this stuff again. What is a little bit interesting to note possibly is that until 96, and I know that's a long time ago for most of you, and probably before the majority of you were born, but in not-for-profit organizations, NPOs or NFPOs, didn't need to follow any kind of GAAP at all. So there are a ton of differences in accounting for not-for-profit organizations amongst not-for-profit organizations, and especially when compared to profit-oriented ones. Now, this one's interesting, and I've scribbled over it, but cash-based accounting was used very commonly in not-for-profit organizations. And, the nature of the business is just so starkly different from for-profit enterprises that was the argument to use cash-based accounting. And cash is just so key. It's king, as they say in these not-for-profit organizations, that it was thought to be, a semi-meaningful representation of the underlying transactions, I should say. So, the CICA at the time, Canadian Institute of Chartered Accountants, which no longer exists. It's the CPAs of Canada. So they wanted to improve the consistency in the accounting, right? And maybe this is like a boring trip down historical GAAP lane, but so they tried to come up with some specific guidelines, and so they created this specific section of the accounting handbook back in 96. It was called Section 4400, and then it was adopted into Part 3 of our current CPA handbook. As it states here, it was formerly called the CICA handbook. So, as I said, Part 1's IFRS, Part 2's ASPE, and then Section 4400 is located in Part 3. And this is where all the guidelines are, if you're interested in that. This kind of stuff makes for a great multiple choice question, by the way. So, Part 3, So here are the main issues that come out of Part 3. Okay, now again, not-for-profit organization may choose to adopt Part 3. They can also, if they want to, apply IFRS, although the vast majority of not-for-profit organizations are not going to do that because it is in fact very complex and onerous. And the revenue and expense streams of a not-for-profit organization differ wildly from that of a for-profit enterprise. Now that's in the instance that a NPO is required to report using not-for-profit accounting. Again, many not-for-profits don't have to report using any GAAP whatsoever and still may use the cash basis of accounting. So what this next little section is going to presuppose is that these not-for-profit organizations that we're going to discuss are going to adopt Part 3. And I'll tell you right now, any questions that I or any other instructor would ask you on an exam would pertain to the actual not-for-profit accounting that is in Part 3 of our CPA handbook. So I'll go through a few of these and then I might make a separate little segment on the last one because that's really where all the accounting comes in. So one of the first issues that shows up is the requirement to use accrual accounting. And this simply states in Part 3 or Section 4400 of our CPA handbook that not-for-profit organizations must accrue liabilities and receivables, the same thing as profit-oriented enterprise. So that's something that you'd be used to. This is not going to be some kind of crazy accounting. Cash basis of accounting, no longer permitted. Can't use cash basis, right? So now we'll get into the financial statements. And these are a little bit different. We're going to see a bunch of weird items that show up on not-for-profit statements. I'll try and flip back and forth to have a look at some examples of these things. So our first financial statement is the statement of financial position, which may also be referred to as the balance sheet. So this is similar to the balance sheet of a for-profit enterprise. I'm going to scroll down real quick and take a look at an example. Here we have the statement of financial position for the United Way of Greater Victoria. I'll walk a little bit through this. What we've got here is a couple of different funds. You might want to ignore the concept of different funds for right now. I'll dig a little bit deeper into that. But you can see that like a regular balance sheet, it's got some assets. And let's just take a look at the balance sheet of the operating fund. You'll notice that as we see more of these things, that each individual fund is going to have its own sort of separate financial statement, which then you would kind of total up at the end. So here's the balance sheet for the operating fund. It's got an assets section, right? And then you total up the assets as you would in any other balance sheet. And what has it got? Some cash, pledges, receivable. We'll talk about that, other receivables, and then some balances between the funds. That basically means with that interfund balance, there's money that's owed from some other fund here. Then we've got some investments, life insurance policy, capital assets, etc. Normal items that you would see on a balance sheet. On the opposite side of the balance sheet is where it gets exciting. We've got liabilities as we would normally have, right? Payables, deferred revenue, your standard liabilities. And then down here we have what are called fund balances. You will also see that referred to as net assets, potentially, right? So here we have fund balances or net assets. In this case, the United Way has chosen to call this side of this part of the balance sheet fund balances, but it could also be referred to as net assets. So you'll see, hey, look, if you total up all your liabilities here, plus your fund balances here, that will equal the total of your assets up here. So that's how your balance sheet works, right? You've got liabilities, and then you've got where you would have an owner's equity section, you've got fund balances. And here's the balance part, which makes it a balance sheet and not just a sheet. So that's your statement of financial position / balance sheet. And it's largely different from that of a for-profit enterprise. You also have the statement of operations, which is fairly similar to an income statement. I don't have a specific example offhand. I think we'll look at one later on, but it's got revenues, it's got expenses on it, The only issue here is because this is a not-for-profit organization, there is no profit. There's also no income tax line item. So those are some key differences. There are numerous examples of these available on the internet, and I think later on in your workbook as well. You're also going to see what we have here, this statement of changes in net assets. Now, this is similar to a statement of shareholders' equity for profit-oriented enterprises. Oh, I thought that would straighten out. For profit-oriented enterprises, which is seemingly a statement that no student is particularly comfortable with. And it looks a little something. I'll just do a quick little run through down here. Here's a statement of changes in fund balances. What did we call it up here? I hope we call it the same thing. My brain's going. Statement of changes in net assets. All right. So, statement of changes in fund balances or net assets, because we've been told that that part of the balance sheet can be called two different things, or net assets. And it's not uncommon to see this statement called two different things. So you will have, in general, let's just focus again on like an operating fund here. Okay, so how is the fund balance changing over the years? We have a fund balance. This is at the beginning of the prior year. So it's not uncommon to reconcile 2 years, but let's say this is the beginning of the fiscal year. Opening balance of the fund, we've got an excess of revenue over expenses, which is going to go right into our, in this case, operating fund. We'll talk about the different funds shortly. We have some transfers. You'll see a lot of the times on these changes in fund balances, you have transfers between various funds, and those are going to show up right here. It talks about notes, and those notes will usually describe why this amount of money changed hands from one fund to another fund. Here we have another transfer from yet another fund. So we have restricted funds and we have operating funds. Again, I'll talk about what those fund balances mean. There's the operating fund, there's the restricted funds, and you can see that these balances transfer back and forth. We have our closing fund balance down here of 6955. So that's just a reconciliation from the beginning of the year to the end of the year. And that's sort of similar to what you'd have for a statement of shareholders' equity or even a statement of retained earnings. Now, you take that 6955 and scroll back up to your statement of financial position. Hey, where have we seen this before? Right here, right? 6955. So that just breaks out the reconciliation of how the fund balances have changed from the beginning of the year to what you ultimately see on your statement of financial position. Exciting, right? I agree. So floating back up here to talk about our statement of cash flows. Statement of cash flows generally is very, very similar to what you would see for that of a for-profit enterprise, and we are not in this class, hallelujah, going to talk about the statement of cash flows for a not-for-profit organization. So I think I'll pause this here and I'll come back and talk specifically about fund accounting. And then I'll do another little piece. You got to break this up a bit. We're almost looking at half an hour here. So we'll talk a little bit about fund accounting and then some contributions, etc. So I'm going to stop this one right here. You can pick it up in our next segment.